The relentless pursuit of market mastery, the eternal quest to decipher the intricate dance of supply and demand, often leads investors and traders down countless paths, each promising the elusive secret to predicting reversals. For generations, the market has presented an enigma, a puzzle whose pieces seem to shift with every passing moment, leaving many to wonder if true foresight is even attainable. Yet amidst this perpetual uncertainty, the wisdom of figures like Jesse Livermore, a titan of early 20th century finance, continues to resonate with an almost prophetic clarity. His profound understanding of market psychology and price action, forged through decades of triumphs and devastating setbacks, offers an invaluable compass for navigating the treacherous waters of speculation. Today, we embark on a journey to uncover one of his most profound insights, the identification of a singular yet multifaceted signal that consistently heralds the conclusion of every major bull market. This is not a mere indicator, but a fundamental shift in the very fabric of market behavior, a silent alarm sounded by the smart money as the music of prosperity begins to fade. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. And remember to return to the channel in difficult times when trading isn't well. Livermore's philosophy was rooted in an unwavering belief that markets are fundamentally cyclical, driven by the timeless, often irrational forces of human nature, chiefly greed and fear. He understood that while the specific instruments and technological mechanisms of finance might evolve, the underlying psychological impulses that propel prices up and down remain immutable. He wasn't interested in making predictions based on arbitrary dates or abstract economic models. His genius lay in meticulous observation. For Livermore, the market itself was the ultimate oracle, constantly communicating its intentions through the language of price and volume. He believed that successful speculation was less about forecasting the future and more about discerning the present reality, responding intelligently to what the tape, the ultimate arbiter of truth, was telling him. This required an acute awareness not only of individual stock behavior, but also of the broader macroeconomic conditions that shaped investor sentiment. He recognized that history, while never repeating itself in identical fashion, certainly rhymed, presenting familiar patterns and psychological dramas that, if recognized, offered profound insights into probable future movements. This deep-seated understanding of market cycles and human psychology formed the bedrock of his legendary career, allowing him to anticipate major turning points with uncanny accuracy, often to the astonishment of his contemporaries. His approach was one of disciplined realism, acknowledging that markets are not rational machines, but vast, complex organisms animated by the collective hopes and anxieties of millions. To ignore this human element, he believed, was to invite certain ruin. The market, in his view, was always right, and the individual speculator's task was to align with its prevailing current, not to fight against it based on personal biases or wishful thinking. He emphasized the importance of patience, of waiting for clear confirmations, and of never acting out of impatience or emotional compulsion. This detached, almost scientific approach to market observation distinguished him from the masses, who were perpetually swayed by rumors, tips, and the intoxicating allure of quick riches. The typical bull market unfolds in predictable stages, each characterized by escalating optimism and broadening participation. Initially, it often begins amidst widespread skepticism, as the market recovers from a previous downturn. This early phase sees cautious accumulation by informed investors who recognize emerging value. As prices slowly grind higher, more institutional money enters, gradually building momentum. The middle stage is characterized by growing confidence. Economic data improves, earnings reports are robust, and the narrative shifts from recovery to expansion. Here, a wider array of quality stocks participate, and the general public begins to take notice, though still with a degree of hesitation. However, it is the final, euphoric stage that truly defines a mature bull market, setting the stage for its eventual collapse. During this phase, optimism becomes pervasive, transforming into outright exuberance. The belief in "this time is different" takes root, convincing many that the upward trajectory will continue indefinitely. New investors, often with little to no prior market experience, are drawn in by stories of easy money and rapidly rising asset values. Speculation becomes rampant, with less attention paid to fundamentals and more to momentum and hype. Prices accelerate, often moving up vertically, seemingly impervious to bad news. Valuations stretch to extreme levels, justified by increasingly imaginative narratives rather than tangible earnings or growth prospects. Everyone, it seems, is making money, fueling a dangerous sense of invincibility. This widespread enthusiasm, this collective delusion of endless prosperity, is precisely what Livermore warned against. He knew that such periods of irrational exuberance were inherently unsustainable, representing the market's most vulnerable state. The temptation to remain fully invested, to ride every last wave of this speculative frenzy, becomes overwhelming for many. The fear of missing out, or FOMO, grips the collective consciousness, pushing individuals to take on ever-increasing risk, often abandoning sound investment principles in pursuit of quick gains. This is when the market, according to Livermore, becomes a dangerous place for the uninitiated, a trap for those who confuse fleeting momentum with enduring value. He understood that the very conditions that make a bull market feel safest and most rewarding, widespread participation, soaring prices, and universal optimism, are precisely the conditions that precede its inevitable reversal. The larger the participation, the more extreme the optimism, the closer the market is to its tipping point. This is not a moral judgment, but a keen observation of human behavior and its predictable effects on collective asset prices. This is the ultimate lesson of Jesse Livermore's life. His journey from a boy in the bucket shops to the king of Wall Street was a relentless struggle to forge this very mindset. The stories of his epic wins and devastating losses are not just market history, they are a profound psychological drama. There is no better way to immerse oneself in this drama, to learn the lessons he paid so dearly for, than by studying Edwin Lefebvre's classic, Reminiscences of a Stock Operator. This book is not a trading manual. It is an intimate look into the mind of a master as he grapples with the very business principles we have discussed. To make this century-old wisdom directly applicable to today's markets, the chapter-by-chapter analysis by Max Davidson is your personal business coach. This analysis treats each of Livermore's campaigns as a case study, dissecting his strategic triumphs and his emotional failures with the clarity of a business school professor. It shows you precisely where the application of a sound business mindset led to millions in profits, and where a lapse into the gambler's mentality led to financial ruin. It is the ultimate guide to understanding and adopting the one mindset that can truly change your trading forever. The link is in the description. The one signal that culminates these characteristics and truly signifies the impending end of a bull market, according to Livermore, is not a single, easily quantifiable indicator, but rather a profound change in the character of the market itself. It is a subtle yet unmistakable shift in underlying dynamics, often missed by the majority who are still caught up in the euphoria of rising prices. The most crucial manifestation of this signal is the discernible weakness or outright failure of the market's leading stocks, those very companies that spearheaded the bull run and propelled the overall market higher. These are the innovative, financially strong, and highly visible companies that captivated investor attention and consistently delivered impressive returns throughout the ascent. They are the engines of the bull market, and when their performance falters, it's akin to the primary engine of an aircraft sputtering out even if the auxiliary engines are still firing. This weakness in leaders presents itself in several key ways. Firstly, these bellwether stocks, which once effortlessly climbed to new highs, begin to struggle. They might fail to achieve new significant peaks, or their advances become increasingly labored, marked by narrower ranges and less conviction. Secondly, and perhaps more tellingly, they start to exhibit signs of distribution. This means that large volumes of shares are being traded at stagnant or even slightly declining prices. Unlike accumulation, where smart money buys into rising prices with conviction, distribution sees informed investors quietly offloading their holdings to the less informed public, who are still eager to buy, believing the trend will continue. The absence of enthusiastic buying pressure in these once dominant stocks, even as the general market appears robust, is a critical red flag. The smart money, having identified that these leaders have reached their peak potential for the current cycle, begins to systematically exit, patiently finding buyers among the eager latecomers. This isn't a sudden, dramatic collapse, but a gradual, insidious erosion of strength, often masked by the broader market's continued upward drift. The leaders, which once sprinted, are now merely walking, then stumbling, while the crowd cheers on the laggards. Accompanying this critical weakness in market leaders is a distinct and dangerous phenomenon: the rotation of capital into increasingly speculative, lower-quality stocks, often referred to as a junk rally. As the primary engines of growth, the leading companies, lose their momentum, retail investors and less discerning funds, still hungry for quick profits, shift their attention to smaller, more volatile, and often fundamentally weaker companies. These are the stocks that were overlooked during the main bull run, or those with highly speculative business models, often trading at exorbitant valuations relative to their actual earnings or assets. The thinking is that if the blue-chip leaders have already had their run, these laggards must surely be next to experience explosive growth. This shift is a sign of desperation and a diminishing pool of genuinely attractive opportunities. Smart money is exiting quality, while uninformed money is chasing anything that moves irrespective of underlying value. This is a classic symptom of a market approaching its top. The focus moves from sound fundamentals to pure, unadulterated speculation, fueled by the illusion that every stock must eventually go up. The market becomes a casino where prudence is abandoned for the thrill of a quick, often ephemeral gain. The junk rally is the market's final desperate gasp, a dangerous illusion that gives the appearance of continued strength even as its foundations are crumbling. Mastering any single aspect of speculation is a crucial step. But to build a complete framework for success, it is essential to learn from those who mastered the entire game. How did the legends of Wall Street truly think during their greatest campaigns? What went through their minds during their most devastating losses? The answers to these questions are the true keys to the kingdom. The lessons of history, the memoirs of those who have navigated the treacherous waters of Wall Street and emerged with fortunes intact, are an invaluable education. To this end, a new channel, Wall Street Memoirs, has been created to serve as a library of this essential wisdom. This is not a channel for hot tips or fleeting market gossip. It is a repository of the timeless strategies, the hard-won philosophies, and the personal recollections of the legends who shaped the financial world. By studying their campaigns, their successes, and just as importantly, their failures, you begin to understand the business of speculation at its highest level. You learn how they managed capital, how they analyzed conditions, and how they cultivated the discipline to act like true professionals. For anyone who wishes to move beyond simple rules and understand the strategic thinking that builds lasting fortunes, Wall Street Memoirs is your next step. The link is in the description. Furthermore, Public Euphoria reaches its zenith during this final stage. Everywhere you turn, people are discussing stocks, at dinner parties and casual conversations, even among those who previously showed no interest in finance. New, inexperienced investors flood into the market, often encouraged by sensational media headlines and the seemingly effortless gains of their friends and neighbors. This widespread participation, especially from those with limited understanding of market risks, is a hallmark of a speculative bubble. Everyone becomes an expert, offering tips and predicting ever higher prices. The media narrative shifts from cautious optimism to unbridled celebration, highlighting record highs and painting a picture of endless prosperity. This pervasive sense of easy money and universal success stands in stark contrast to the quiet, disciplined actions of the smart money who are systematically reducing their exposure. The more vocal and widespread the public's excitement, the greater the likelihood that the market is topping out. This emotional crescendo is often the final act before the curtain falls. Finally, the market itself becomes thin at the top. This means that while the headline indices might still be making new highs, fewer and fewer stocks are actually participating in the advance. The gains are concentrated in a narrowing group of equities, often the aforementioned speculative laggards, while the broad majority of stocks are either stagnant or already showing signs of decline. This lack of broad participation indicates a weakening underlying structure. The market's internal health is deteriorating, even if the surface appears robust. It's like a building where the facade is being painted while the internal support beams are cracking. This thinness implies that the market's momentum is no longer broad-based and sustainable, but is instead propped up by a shrinking number of assets and an increasingly speculative fervor. The smart money observes this internal divergence, recognizing that the broad accumulation phase has ended and a dangerous distribution phase has begun. They understand that a market that is not broadly healthy cannot sustain its upward trajectory indefinitely. This combination, the failure of leaders, the rotation into junk, widespread public euphoria, and market thinness, forms the multifaceted one signal that Livermore identified as the harbinger of a bull market's end. This signal, characterized by the failure of market leaders and the shift to speculative excesses, is critically important because it reveals the actions of the smart money. These are the large, informed institutional investors, professional traders, and sophisticated individuals who possess deep insights, extensive research capabilities, and the capital to move markets. When these intelligent participants begin to exit the very stocks that have driven the bull market, it indicates a fundamental shift in their perception of future value and risk. They are not selling because of a whim or an emotional reaction. They are selling because their analysis suggests that the growth prospects are diminishing, valuations are stretched, and the risk of a significant correction outweighs the potential for further gains. Their exit signifies a loss of conviction in the market's primary engines. Furthermore, this signal demonstrates a fundamental shift in the market's underlying dynamics. The engine of the bull market is quite simply stalling out. A healthy bull market is characterized by strong earnings growth in leading companies, expanding economic activity, and a broad-based accumulation of quality assets. When leaders fail to make new highs or begin to distribute, it means these fundamental drivers are losing steam. The market is no longer being propelled by genuine growth and value creation, but by momentum, speculation, and the sheer force of investor psychology. This transition from accumulation to distribution is crucial. Accumulation, the buying by informed investors, fuels sustainable rallies. Distribution, the selling by informed investors to the uninformed public, is the precursor to a decline. The smart money isn't just taking profits. They are actively repositioning themselves for a downturn, often moving into cash or even initiating short positions, anticipating the eventual collapse. They are acting on information, not on hope. The signal provides an early warning, often preceding the general market downturn by weeks or even months. While the major indices might still be grinding higher, buoyed by the speculative surge in lower quality stocks, the internal weakness is already apparent to those who know what to look for. This early warning is invaluable because it allows disciplined traders and investors to preserve capital, reduce exposure, or even profit from the impending decline. Waiting for the general market indices to confirm a top is often too late, as a significant portion of the decline may have already occurred. Livermore understood that proactive observation, rather than reactive analysis, was key to navigating these pivotal moments. He recognized that the market whispers its intentions before it shouts them, and the failure of leaders is one of the clearest whispers. It's a sign that the fundamental reason for the market's ascent has evaporated, replaced by unsustainable froth. This shift from fundamental strength to speculative weakness is the core reason why the signal is so critical. It identifies the moment when the market's internal structure becomes dangerously fragile, setting the stage for a reversal that will catch the majority by surprise. For traders and investors, the implications of recognizing this one signal are profound and directly actionable. First and foremost, it necessitates an unwavering commitment to being observant, not emotional. The market's final stages are designed to entice and trap, to make one feel foolish for not participating in the seemingly effortless gains. However, a disciplined approach, guided by Livermore's principles, demands a detached, almost scientific scrutiny of market behavior, free from the pervasive influence of greed or fear. One must resist the urge to chase the final, often explosive rallies in speculative stocks, understanding that these are typically the last vestiges of a dying bull market, offering fleeting gains at extreme risk. The primary focus must shift to the behavior of market leaders. These are the stocks that commanded attention and respect throughout the bull run. When they falter, when they fail to make new highs with conviction, or when they show signs of distribution on heavy volume, it is a clarion call to reassess one's entire market position. It means the powerful engines that drove the market are sputtering, and their exhaustion signals a broader fatigue. This requires an investor to look beyond the headline indices and delve into the internal dynamics of the market, paying close attention to sector rotation and the relative strength of the most prominent stocks. If the leaders are no longer leading, then who is? And are those new leaders sustainable? A critical consequence of this signal is the imperative to avoid the temptation of the final speculative surge in secondary or junk stocks. While these may offer tantalizing quick profits in the short term, they represent the riskiest segment of the market, often lacking fundamental support and trading solely on momentum and hype. Participating in such rallies is akin to entering a burning building for a few last pieces of furniture. The risk of catastrophic loss far outweighs the potential reward. Livermore understood that preserving capital is paramount, especially during the terminal stages of a bull market. The goal is not to extract every last penny from the market, but to protect what has been earned and position oneself to capitalize on the next major trend, which often begins after a significant correction. This means resisting the psychological pull to join the crowd, even when the crowd seems to be winning. It requires a deep-seated conviction in one's own analysis and a willingness to stand apart. The emphasis shifts dramatically towards capital preservation. During the early and middle stages of a bull market, the focus might be on aggressive growth and maximizing returns. However, as the one signal emerges, the priority must pivot to safeguarding existing profits and minimizing potential losses. This might involve reducing overall market exposure, selling off weaker positions, taking profits in leaders that are showing signs of distribution, or even moving to a significant cash position. For more aggressive traders, it could involve initiating carefully managed short positions, though this carries its own set of risks and requires a high degree of skill. The key is to recognize that the risk-reward dynamic has fundamentally shifted, and what was once a favorable environment for long positions is now fraught with danger. Finally, the signal underscores the immense importance of patience and waiting for confirmation. Livermore was a master of patience. He understood that acting too early, based on incomplete information or emotional impulse, was a recipe for disaster. While the signal provides an early warning, it doesn't necessarily mean an immediate crash. Markets can often top out over a period of weeks or even months, characterized by choppy, volatile action. The wise investor waits for clear, sustained confirmation of the shift, perhaps a breakdown of key support levels in major indices, or a widespread and undeniable distribution pattern across multiple sectors. This patience allows one to avoid false signals and to execute decisions with greater conviction and less emotional interference. It's about letting the market speak clearly, rather than trying to guess its intentions prematurely. By adhering to these principles, observation, focus on leaders, avoiding speculation, capital preservation, and patience, traders and investors can navigate the treacherous end stages of a bull market with greater confidence and significantly reduce their exposure to the inevitable downturn. They are not trying to predict the exact peak, but rather to recognize when the character of the market has changed, signaling that the game is no longer in their favor. In sum, the profound wisdom distilled from Jesse Livermore's extensive experience reveals that the end of every bull market is not marked by a single dramatic event, but by a subtle yet fundamental change in the market's character. This change is most acutely observed in the failure of market leaders, those dominant stocks that spearheaded the ascent, to continue their upward trajectory with conviction, often exhibiting signs of distribution on substantial volume. This critical weakness in the market's engines is invariably accompanied by a perilous speculative excess in lower tier, often fundamentally weak, stocks, fueled by widespread public euphoria and a desperate hunt for quick profits. The market, in essence, becomes thin at the top, with fewer and fewer quality stocks participating in the overall advance, masking internal deterioration with superficial exuberance. This powerful insight, forged in the crucible of real-time market action and profound personal experience, underscores the timeless relevance of Livermore's principles. His emphasis on meticulous observation, disciplined interpretation of price and volume, and an unwavering focus on the underlying psychology of the crowd remains as pertinent today as it was a century ago. He taught us that true market mastery lies not in predicting the future with scientific precision, but in understanding the present with acute clarity. It is about discerning the hidden messages the market constantly transmits, particularly when the prevailing sentiment is one of unbridled optimism. The call to action for every serious investor and trader is clear. Cultivate an independent mind, resist the intoxicating allure of crowd sentiment, and commit to a rigorous study of market behavior. Do not blindly follow trends or succumb to the pervasive fear of missing out. Instead, develop the capacity to listen to the market's subtle cues, especially those emanating from its most influential components, the leaders. When the leaders falter, when quality is abandoned for speculation, and when the public's euphoria reaches its peak, the astute observer understands that a significant shift is underway, signaling the inevitable conclusion of the current cycle. The market always communicates its intentions, always speaks to those who are willing to listen with an open mind and a disciplined approach. The wisdom of Jesse Livermore reminds us that the greatest profits are often made by those who have the courage to stand apart from the crowd, to recognize the subtle changes that precede the obvious, and to act decisively when the character of the market unequivocally declares that the bull's run is finally over. This is not about being a prophet, but about being a shrewd, patient, and observant student of the endless drama that unfolds on the ticker tape.